Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the economy in Turkey. Now, if you've been following the channel, you'll know that we've been talking about Turkey for the last few years, and the problems that it's been encountering are still going on. And in today's video, we'll go through the latest data in terms of inflation, which actually came down slightly in June. So that sounds like a positive development. However, it's still in the top 3 in the whole of the world. And it's around 20 times higher than it is in the USA, 35 times higher than the UK, and over 230 times higher than the inflation in China right now. Now, that is actually an anomaly because China's got the opposite problem to the rest of the world. It doesn't have enough inflation right now, but that's to be talked about in a different video. So in today's video, we'll go through that inflation data for Turkey. We'll talk about what's driving that inflation up. We'll have a look at what's happening with interest rates because you'll know if you've been following the channel, over the past few years, Turkey was operating a contrarian policy whereby it was actually reducing interest rates at a time of high inflation. That didn't work out too well for the economy in Turkey. So they've now changed that strategy. So they've been increasing interest rates, and Turkey now has one of the highest rates of interest out of every country in the world. So we'll have a look at what's going on with that. We'll then talk about what's happening with the currency because the Lira has suffered badly over the past few years, partly as a result of that high level of inflation and partly due to the fact that a lot of people in Turkey no longer trusted the Lira and wanted to use the dollar instead. And President Erdogan has been introducing a variety of different initiatives to try to persuade people to start using and trusting the Lira again. We'll then have a look at what's going on with the balance of trade because this is one of the fundamental problems for Turkey, that it's a net importer. So it's paying out more for all of the things that it's buying than it's receiving for the things that it's selling. So that's putting pressure on its reserves and it's having to dip into those reserves. That's also dragging down the value of the Lira, and this becomes a really vicious circle. So we'll have a look at where we are on the balance of trade. We'll touch on where we are with regards to unemployment and wages because they're important factors in terms of the long-term strength of the economy. We'll have a look at the producer price index, which tells us what the factory gate prices are doing in Turkey right now. We'll check out what's going on with regards to Turkey's national debt. And then finally today, I'll wrap up with my summary as to what I think is likely to happen in Turkey over the course of the next 3 to 6 months and what the impact will be on the global economy. But before we get started on all of that, I've got some really exciting news for you. I've decided to give away another one of my sculptures, and it's this piece, which is called Windswept Clock because it's actually got a fully functioning clock built into it, and it's by a British artist called Paul Margetts, who I've got a lot of different pieces from, and I think this is absolutely fantastic. It's really heavy. This would look amazing in anybody's place. And you can win this by entering into the prize draw. And the tickets are priced at only £1 each, which is around $1.30. So if you want to support the channel, rather than buying me a coffee or sending me a YouTube super thanks, why don't you buy a ticket and you could win this thing? And you can follow on from the previous winners like Craig in Australia, who won the little red balloon dog, and Lars from the Netherlands, who won Stiltman. And there is a potential, if you do win, that you may have to pay some import duty. I don't think Craig or Lars did, so maybe you won't. And I'm getting an independent company to organise everything for me, so it's all above board. I won't be involved in drawing the winner. That's entirely at random. But if you'd like to win this, an original Joe Blog sculpture, you can't buy these things, you can only win them, then have a look at the details below and buy a ticket and good luck. This chart shows the movement in the official rate of inflation in Turkey over the past 12 months. And one thing to note here is that the scale on the right-hand side of this chart does not start at 0. It actually starts at 35% and goes up to 85%. And what we can see here is that this time 12 months ago in June 23, the official rate of inflation was 38.2%. However, over the following few months, inflation started to take off and hit 61.5% by September. And by the end of 2023, inflation was just under 65%. And unfortunately, from Turkey's perspective, inflation continued to take off in the first 5 months of 2024, rising to the highest point of 75.5% in May. Now in June we have seen a slight reduction. It's back down to 71.6%, which obviously is an improvement in terms of the trend. It's good to see inflation starting to come back down. But when you take a step back and look at the last 12 months, 71.6% is actually the second highest rate at any point during that period. And if we compare it to the rest of the G20, you can see that Turkey has the second highest rate of inflation. Only Argentina, which is in a state of complete economic chaos right now, has a higher rate of inflation. And the next highest rate in the G20 is Russia at 8.3%. So there is a huge gulf between Turkey and the rest of the G20. And if we compare Turkey's rate of inflation to every country in the world, Turkey has the third highest level. Only Argentina and Syria, which is a war-torn country, have higher rates of inflation. And Turkey has more inflation than Venezuela, Zimbabwe, Palestine, Lebanon, Congo, Sierra Leone, Nigeria, and many other countries that are also in a state of economic crisis. And if we expand the inflation chart to see what's been happening over the past 5 years, you can see that the current levels of inflation represent a second wave in terms of rising levels. At the back end of 2021, inflation started to take off in Turkey, rising from 21% in November to a peak of 85.5% in October 2022. Now, inflation during that period was predominantly driven by what was happening in the war in Ukraine, because global commodity prices, the price of things like oil and gas and food substances, rose dramatically as a result of the disruption to the global supply chains and the fact that Russia was no longer selling its goods to countries in the West. So there were really big movements, and that drove up the price of all of those commodities. And that really hurt Turkey because, as a net importer, a country that has to import large volumes of fuel and food, it was suffering, and it also had a problem with regards to the devaluation of the Lira, which made all of those imports proportionately more expensive. Now, interestingly, at the back end of 2022 and the start of 2023, inflation started to come back down and got back down to a level of 38.2% by June 23. Now, in most situations, when you start to see falling inflation, you would expect that that's because the central bank of that government has started to take action in terms of interest rates. So let's have a look at what's been happening to interest rates in Turkey over the course of the last 5 years. This chart shows the movement in the official rate of interest in Turkey over the past 5 years. And as you can see, 5 years ago, the official interest rate was 19.75%. Now, in line with most other countries, during the COVID pandemic in 2020, interest rates were reduced and got down to a low of 8.25% in the summer of 2020. However, as Turkey came out of the COVID pandemic and demand and inflation started to take off, interest rates were raised again and were put back up to 19% by the summer of 2021. Now, as we just discussed, during 2022, inflation started to take off in Turkey. However, President Erdogan and the Turkish Central Bank, rather than following the traditional policy of increasing interest rates at a time of high inflation, decided that they wanted to do the opposite. They would start reducing interest rates to bring inflation back down. And in the period between September 2021 and June 2023, interest rates were reduced from 19% to a low of 8.5%. But as we've just discussed, that strategy didn't work, and inflation took off and rose to above 85%, one of the highest levels in the whole of the world. Now, following his recent re-election, President Erdogan appointed a new finance minister and decided to change the strategy back towards a traditional approach of increasing interest rates at a time of high inflation. And over the past 12 months, the official interest rate has risen progressively from 8.5% to the current level of 50%. And if we have a look at how that compares to the rest of the G20, you can see that Turkey is top of the shop here. It has the highest interest rate out of all of the countries, including Argentina, where the rate of inflation is almost 300%. Their interest rate is now down to 40%, so it's below the level in Turkey. And if we look at the whole rest of the world, only one country, Venezuela, currently has a higher interest rate at just under 60%. So this clearly indicates that Turkey has major problems, because when your interest rates are sitting at 50%, although it potentially could encourage people to put their money in the bank and earn 50% interest on their savings, in reality, it isn't doing that because inflation is actually running at 71%. So the value of your money is falling on a real basis. If you're earning 50% interest, but prices are going up 71%, and the bottom line when the interest rate is this high is that nobody wants to take on any new debt. And therefore it discourages both people and companies from borrowing to spend, and that's going to have a detrimental impact on the overall economy. This chart shows the movement in food inflation over the past 12 months in Turkey. And if you follow the channel, you'll know that we like to look at this metric because it tells us what the situation is like for the poorest members of society, because they're spending a much higher percentage of their cash on food than richer families. So it tells us what the living conditions are like for the poorest members of society. And what this shows is that this time last year, in June 23, food inflation was running at just under 54%, which is obviously extremely high. However, by September, it was up to 75%, which is off the scale. And unfortunately, over the last 9 months, it's remained above 65%. And in June 2024, the official figure is 68.1%. So that means that compared to this time last year, food is 68% more expensive. That's higher than the general level of inflation, and that is a lot higher than the increase in wages in Turkey over the last 12 months. So all of this means that people and families in Turkey have less money today than they did 12 months ago. Food prices are going up, and therefore they'll be able to buy less food. So this is a real life problem. It means that people are eating less. They're potentially not having enough food to put on the table for their families, so people are going hungry. And that is a major problem from Turkey's perspective. And if we quickly compare the situation to the rest of the G20, only Argentina has higher food inflation at almost 300%, and obviously that's a major problem. And the next highest after Turkey's rate is Russia, where it's around 9%. And if we look at the rest of the world, only 3 countries, Argentina, South Sudan, and Zimbabwe, have higher levels of food inflation. The price of Turkey's food is increasing at a faster level than countries such as Venezuela, Malawi, Nigeria, Haiti, Palestine, Angola. And this really puts into perspective just how serious the situation in Turkey is right now. This chart shows the year-on-year movement in producer prices in Turkey. And producer prices are also referred to as factory gate prices. So this is the price of products as they're leaving the factories. And the reason that this metric is important is that it gives us a good indication as to what's likely to happen to prices over the course of the next 3 to 6 months. And what this data shows is that this time last year, in June 23, factory gate prices were increasing by around 40%. That increased to just under 50% by August 23, but then came back down again to around 40% in October. However, in the 7 months through to May 24, there was a rapid increase in producer prices, and by May 24, they were increasing by almost 58%. Now, in June, we have seen a reduction in the year-on-year movement. However, it remains above 50%. So what that means is that the cost of producing goods in Turkey right now is 50% higher than it was this time last year. Now, that's a problem in terms of trying to bring inflation back under control, because those products are going to be hitting the shelves in Turkey over the next few months. So we've got a 50% increase that's already locked in. So in terms of bringing inflation back down to a manageable level of maybe 10 or 15%, there is absolutely no chance. Prices are likely to keep increasing by around 50%. But one of the biggest factors here is that Turkey needs to attract investment from overseas. It needs countries such as China and Russia to start investing into building factories, because Turkey is a big manufacturing base. It makes lots of products that are then exported all around the world. But when you've got producer prices increasing year on year by 50%, that isn't going to encourage overseas investment, because companies won't want to invest tens of millions of dollars building and establishing factories if the price of producing things is going to be increasing by 50% year on year, because global inflation is much lower than that. If you look at economies like the USA, the UK, Canada, inflation is currently sitting at around 2 or 3%. So you can't accommodate a 50% increase in the cost of producing your goods and then expect to be able to export them all around the world. So the current high level of producer prices is really discouraging overseas investment, and that's a big problem for Turkey because it needs to start improving its output and its GDP in order to trade out of its current problems. This chart shows the movement in the exchange rate between the US dollar and the Turkish lira over the past 5 years. And what this shows is that 5 years ago, one US dollar was trading for around 5.6 Turkish lira. Today, it's trading for more than 32.5, which means that the value of the lira has fallen by almost 6 times over the past 5 years. And if you look at the shape of this chart, you can see that there's actually been an acceleration in the devaluation of the lira over the course of the past 12 months or so. In May 23, one US dollar was trading for around 20 Turkish lira, which means that during the course of the last year, the value of the lira has fallen by around 40%. And that's a major problem for a country like Turkey, which is a net importer because it's having to buy things like oil and gas and wheat in the international markets. And those products are generally priced in US dollars. So Turkey is having to exchange lira for dollars when it's making those purchases. So when the value of your currency is falling so rapidly, it means that everything is becoming more and more expensive. Even if the price of oil remains entirely static, if it just sits and doesn't move at all, if your currency is falling on a weekly basis, you're having to pay more every single week for those purchases. And that applies more pressure onto your economy, makes your currency less attractive, potentially therefore results in a fall in the value of your currency, which therefore means it becomes more expensive to buy all of those imports, and so it goes on. It's a very vicious circle. And that's the situation that Turkey finds itself in. And that's one of the reasons why there's a high level of dollarization in Turkey right now, because the fact that the value of the lira is falling consistently means that people are happier to be paid in US dollars and also to make payments in US dollars. They believe that the long-term value of the dollar is more stable and reliable than the value of the lira. And this becomes a problem because President Erdogan has tried to encourage both the people and the companies in Turkey to move back to using the lira. But when you continue to see the value falling in the international markets, it's hard to have faith in your currency. This chart shows Turkey's balance of trade over the past 12 months. And as we've discussed before, the balance of trade is simply the difference between the value of all of your exports, so all of the money that you're being paid, and the cost of all of your imports, so the amount of money that you're paying away. And what you can see here is that in every single one of the last 12 months, Turkey's balance of trade has been in negative territory. The scale on the right-hand side of this chart starts at 0 at the top and goes down to minus $13 billion at the bottom. And if I expand the scale of this chart out to show what's been happening over the past 5 years, you can see the size of the problem that Turkey is facing, because in every single month in the past 5 years, Turkey has been running a negative balance of trade. So this is basically the same as you spending more every single month for the last 5 years than you're earning. At some point, you're going to need to be bailed out. You need something else to be able to cover the cost of all of your spending. And in Turkey's situation, what it's having to do is dip into its reserves. This chart shows Turkey's unemployment rate over the past 5 years. And what this shows is that in May 2019, unemployment was running at 13.7%, which is a very high rate. However, over the past 5 years, there has been a significant downward trend. You can see that the rate of unemployment has been coming down consistently. And the most recent figures that have been published show that the current unemployment rate is 8.5%. So that's obviously significantly better than it was 5 years ago. However, 8.5% is still a high level of unemployment. If we compare it to the latest rates for the rest of the G20, you can see that only South Africa at 32.9%, which is extremely high, and Spain at 12.3% have higher rates of unemployment. And this chart shows the movement in the level of youth unemployment. So basically people under the age of 25 who are actively seeking employment but can't find a job. And what this shows is that in May 2019, youth unemployment was running at almost 24% in Turkey. There has been a reduction over the past 5 years, but the latest figures show that youth unemployment is still at 14.5%. And this is obviously a major problem because these young people should be feeding through into the employment system. They should be getting qualified, becoming skilled, and therefore setting themselves up for a lifetime of employment. If you can't get a job in that key period between leaving school or higher education and the start of your career, then it's difficult to become skilled, and that's going to increase your chances of becoming long-term unemployed. Now, interestingly, when you compare the current level of youth unemployment in Turkey to the rest of the G20, there are a number of countries that have higher levels of youth unemployment. South Africa currently has the highest level of youth unemployment in the G20 at just under 60%, which clearly means that there are major problems starting to build in South Africa. Spain's youth unemployment is over 26%. However, interestingly, Italy comes in at number 3 with youth unemployment of more than 20%, and France is at number 4 with youth unemployment of just under 18%. And when you look at the rest of this table, with China and the Euro area having youth unemployment above 14%, Canada above 13%, United Kingdom almost 12%, Australia almost 10%, and the United States and the Netherlands almost 9%. You can see that there are problems all around the world right now because when you've got high levels of youth unemployment, it becomes a problem integrating those people into your employment system over the course of their lifetime. This chart shows the movement in Turkey's national debt between 2019 and 2024, and also forecasts what's likely to happen in the period out to 2029. And what you can see here is that in this 10-year period, there has been a consistent and rapid increase in the total amount of debt that Turkey owes. Back in 2019, the official national debt figure was just under $43 billion. However, it's expected that in 2024, the national debt figure will be almost 10 times higher at just under $393 billion. And by 2029, it's expected that the figure will increase to $1.3 trillion. So what's the summary and conclusion today? Well, I wanted to post this video because we've been following Turkey for a long period of time, and I think the situation there is really quite interesting, and it remains critical, unfortunately, for the people of Turkey. Inflation has come down slightly in June, but it's still sitting above 71%. Which means that it's actually the second highest in the G20. Only Argentina has a higher rate of inflation, and Argentina is in a world of pain right now. And if you're interested in finding out more about that, check out the recent videos that I've been posting because we've been following Argentina alongside Turkey. And it also has the second highest rate of interest out of every country in the world. And when you get to that point, when your inflation is off the scale and your interest rates are off the scale, it becomes really difficult for the central bank and the government to be able to control things. And the reason why interest rates and inflation are so high is because there is now a disconnect between the two. So in most countries, we see a situation whereby the central bank will increase interest rates to discourage spending. If you increase the cost of borrowing, then people and companies will be discouraged from taking on new debt because it's more expensive. That means that they will spend less, generally speaking. Therefore, demand should fall, and that should bring prices back down. So that's one of the key levers that central banks use to try to bring inflation back under control. But when you have a disconnect between your interest rates and inflation, like there is right now in Turkey, increasing interest rates doesn't actually have that big an impact because most people don't want to borrow in Lira. They don't want to keep their savings in Lira, partly due to the fact that the Lira has depreciated in value so rapidly over the past few years. So if you think about that situation, if you had your life savings, let's say you had 100,000 US dollars, but you were keeping it in Lira. So you had 100,000 US dollars equivalent in Lira. When the value of the Lira falls, that reduces your pot. So your savings go down in terms of how much you can actually buy in the international markets. And also, when inflation rises in your country, that means your purchasing power also falls, because if prices rise 71% on average year on year, you need your savings to be increasing by 71% just to be able to buy exactly the same today as you could this time last year. And as we've just discussed, interest rates are only at 50%. So over the last 12 months, interest rates have been going up less rapidly than inflation. That reduces the purchasing power of Lira. And that's one of the reasons why people don't want to hold their savings in Lira, because you don't want to see the value of your savings evaporating. They should be going up. So that's why a lot of people prefer to use the dollar. So we have this disconnect in Turkey right now, which is causing major problems for the central bank in terms of getting inflation back under control. And also because Turkey is a net importer, it's having to buy in things in the international markets. And as the value of the lira deteriorates, that means that those things become proportionately more expensive. So that's driving up inflation. So this is a really difficult situation for Turkey to try and solve. What it needs to do fundamentally is create more employment, create more jobs, create more industry, create more profit. Therefore, the economy can grow, and people would then potentially start having more faith back in the lira. The value might start to increase in the international markets, and that could bring the economy back to a situation where interest rates and inflation are actually linked. But unfortunately, Turkey is a long way from being at that point. And as we've seen from today's data, the balance of trade continues to be negative. So that means that it's having to pay more for all of its imports than it's earning for its exports. The capital flows are negative, so it's paying out from its reserves. All of this is putting more pressure on the central bank and the government. Unemployment is at a relatively high level, over 8%. So that means that there aren't all of those jobs that you need to keep boosting the economy. And all of this is presenting a major problem for President Erdogan in terms of trying to fix the situation. So in terms of the outlook over the next 3 to 6 and probably the next 12 months, it remains critical. Inflation is likely to remain high. It may continue coming down from 71%. We may get down to 60% or maybe even 50% over the course of the next 12 months. However, 50% inflation is still really, really high. If you think about prices going up 50% over the next 12 months, that would mean that your income would also need to go up at least 50% in order to maintain your purchasing power. That isn't happening in Turkey. So people are under more and more pressure. And as we saw earlier in the video, food inflation is actually running at a higher level than general inflation. And that's clearly bad news for the poorest members of society who spend more of their income on food. So all of this is adding up to major problems for Turkey over the course of the next 12 months. It's unlikely that they're going to be able to turn things around rapidly. They need an investment program. They need to encourage overseas investment into Turkey. President Erdogan is trying to encourage countries like China and Russia to invest into Turkey. But interestingly, over the last 12 months, the level of trade between Turkey and Russia has actually been falling as a result of the risk of secondary sanctions. Turkey doesn't want to lose its business with the West, and it's a fine balancing act maintaining that relationship with Russia and also keeping everybody that's applying sanctions against Russia happy at the same time. That's a really difficult thing to be able to do, and that's proving a problem for Turkey and meaning that it's now doing less in terms of exports directly to Russia. So the overall summary of today's video is that the fundamental problems in Turkey remain. It's going to be very difficult to turn things around, and we'll keep having a look at the data as it comes out on a monthly basis to see whether or not the central bank is achieving its goal of bringing inflation down, bringing interest rates back down, driving up GDP and improving the economy, or if things are just past the point of no return. And I think it will be really fascinating to see what happens over that period and if things can be improved. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.